Hello everyone, and welcome to the CutOffPoint.ca blog. Today, what I wanted to discuss is how you can calculate accurately your rate of return in order to assess your performance. Now, calculating your rate of return may seem like a relatively simple and straightforward process. Take the amount you begin with, see how much you have in your account at the end of the period, and simply calculate a return based on that. So let's say you start off your account with $100 on January 1st. At the end of the year, your account is now worth $120. You can calculate you had a $20 gain on that account. And finally, divide that by your original $100 amount to calculate a 20% rate of return. And that's a very straightforward and valid way of calculating your rate of return. Where things get a little bit murkier is if there are transactions throughout the year. So let's say, for example, we start off the year with $100 in our account. On November 31st, we then calculate our market value is $120. We decide to add an additional $10 at that moment, bringing our market value to $130. And then let's assume there are no more gains throughout the year, and we close on December 31st at $130. We could use the same method that we just used. We started off with 100. We ended the year with 130. However, now we have to account for that $10. Now, let's say we simply add that $10 to the beginning amount. So we could say, okay, well, we had $110 invested. We ended the year with 130. That's a $20 gain on $110 invested equals 18.2% rate of return. However, in this example, we can clearly see, compared to the previous example, in both cases, we generated $20 as fund managers. Now, did we really reduce the returns on the account by adding that additional $10? And the reason why we have that difference between those two amounts is because of the time value of money factor. In order to properly calculate your rate of return, you have to remove the timing of those cash flows which you do not control. So returning to our example, we would break up our calculation into two periods and then link them together. Our first period, running from January 1st to December 1st, where we began with $100, ended with $200, 100% rate of return. In a second period, where we would begin our period with the additional money included, so a $1,200 market value, ending the year with a $1,250 market value, $50 gain on that period, giving us a 4.17% rate of return. We would then link them together by going 1 plus, in this case, 1 times 1 plus 0.0417, linking those two rates of return together, giving us an ultimate value of 1.0834 after we remove 1 from our answer in order to remove the original capital. So that 108.34% genuinely represents what you generated as a portfolio manager in your accounts, removing the effect that the timing of cash flows, which you did not control, had on you. Now, as you can imagine, this could become very difficult and time-consuming to calculate if there are many cash flows, if you're doing weekly or bi-weekly investments, for example. This is why I will do a follow-up video that will explain how to use Excel to calculate this rate of return for you. Thank you for listening to my video, and as always, let's learn to become better investors together.